What we got right in 2016 and what will happen in 2017. David and Libby Koch. Welcome to what we call our annual moment of truth and dare. This is the 11th year of our tradition here at MSHQ to start every year by daring to look into our crystal ball and try to forecast what may happen over the next 12 months. David Koch on whether you should get a credit card. At the same time, it's our moment of truth, where we assess last year's forecast and subsequently either revel in the glory of getting it right or suffering the embarrassment of getting it wrong. The sections in italics are what we predicted this time last year for 2016. Even though we have the privilege of adjusting our views through this weekly section, it's important we hold ourselves accountable on an annual basis. It's good or embarrassing for the soul. So here goes. Economy. Surely commodity prices have bottomed now and will just bumble along the bottom. Economic growth could improve a little over the next year to between 2.5 and 3%. Not a return to boom times. Continued improvement in the US economy should help offset stagnation in Europe and Japan. China, world comes to the realization now a massive, mature economy where normal first world economic growth rates will be the norm. Aussie dollar trending toward the mid to high US 60C level. A solid result for us. Our economic forecasts were traveling quite nicely until the surprise economic contraction in the September quarter cut annual growth back to 1.8%. But we're confident the December quarter figure, which comes out beginning of March, will be a big improvement and the annual growth will be closer to the 2.5% mark. The US economy has improved and the world has realized China has matured and is maintaining solid growth. Commodity prices have surprised on the upside with good price gains for iron ore and coal. Our prediction at the end of last year for a bottoming in commodity prices was quite bold compared with others who forecast continuing decline. As far as the currency is concerned, the Aussie dollar did certainly trend down, but not quite to the mid to high US 60C mark yet. In 2017 we expect the Aussie dollar to be in the US 60s as the American dollar rises on the back of a stronger economy and more interest rate rises. While the lower currency will make imports and traveling overseas more expensive, exporters and tourism will get a boost. Overall, a lower Australian dollar is good for the economy. With the US going stronger and China staying solid, commodity prices should be able to rise further as well. Overall, another steady year of economic growth of around 2.5 to 3% with maybe one or two official interest rate hikes coupled with unemployment staying below 6%. Shares. Australian share market will stay volatile and will end up lower, but by less than 5%. Resource stocks should stabilize, and while bank margins will remain under pressure, their strong dividends will keep their share prices steady. Exporters will prove to be a bright spot along with companies with strong profits. From overseas. Remember last January? The financial world was falling apart as markets were gripped with despair about the global economy and a series of crises which many experts saw a precursor to economic recession or, for some, depression. Our share market followed the rest of the world and fell almost 10% in that first month alone. What a turnaround since then, with the American share market bounding up to record highs and Australia followed with an 8% rise over the year. So our forecast of a less than 5% fall, while better than most other forecasters at the time, was a fail. Having said that, resource stocks did stabilize and make nice gains while exporters and major bank shares have stayed solid. But we're just clutching at straws and a couple of wins to hang our hat on. The truth is our 2016 share forecast was a fail. As for the share market in 2017, it's all about Trump. The president-elect promised a lot in his campaign, and a lot of it will be good for American business and the economy. Proposed big corporate and personal tax cuts, less regulation, a commitment to rebuilding the U.S. manufacturing sector, and a reassessment of free trade agreements, to name just a few. If he delivers on these promises, he has backed out of quite a few other election promises, then the American economy and share market will continue on its record run with a similar ripple effect to our market. If Trump does not deliver on those good-for-business promises and doesn't make America great again, then the whiplash effect by markets could be severe. Residential property. No crash in the Sydney property market, but a definite slowdown. Perth, Brisbane and the Gold Coast will improve, while Melbourne will slow but remain positive. Flat for Adelaide, Hobart, and Canberra. Up until the September quarter, residential property prices rose in Melbourne, plus 6.9%, Hobart, plus 6.8%, Canberra, plus 5.5%, Sydney, plus 3.2%, Adelaide, plus 3.2%, and Brisbane, plus 3.1%, and fell in Darwin, minus 7.2%, and Perth, minus 4.0%. Pretty well as we expected. Sydney has slowed without crashing, Melbourne has slowed, but still stronger growth than we expected. Hobart was better than we thought, as was Canberra. Perth was still pretty bad, although we thought it would have turned. The prestigious Economist magazine in London has assessed Australian residential values are 40% too high. We don't agree with that, but this year is going to be tricky. The cost of money is set to change. The impact of rising interest rates, both official and bank-induced, on the back of the US and European trends is hard to predict, but there will be a fallout. The expected big increase in new properties coming to market will tip the demand and supply balance more in favor of buyers. Overall, the slowdown in property prices will continue for Sydney and Melbourne, while Brisbane will take a bit of a hit as well. Darwin and Perth property declines look to be bottoming out, while Adelaide, Canberra, and Hobart will stay positive but flat.